Hey everyone, welcome back to the Deep Dive.
Great to be here.
This is where we try to cut through all the noise from the earnings calls.
Exactly. Get to the core of it.
And really pull out the key stuff you need to know. Today, we're looking at Adamas Trust, Inc.
Right.
Used to be New York Mortgage Trust, right? We're digging into their Q2 2025 call.
And this quarter, Q2 2025, it was pretty significant for them.
Yeah, sounds like a major pivot.
A real turning point, I'd say. Big strategic shifts happening in that, mortgage REIT space. Lots to unpack.
Definitely. So let's kick things off with the headline numbers. How did they actually do?
Pretty strong on the earnings front, actually.
Okay.
Their non-GAAP E, that's earnings available for distribution, came in at $1.22 per share.
So that beat the street.
Comfortably beat the Zacks consensus, yeah. That was lower lows and 20 cents, and it's up 10% from Q1.
Okay, solid growth there. Anything else jump out on income?
Yep. The adjusted net interest income per share also climbed 10% quarter over quarter, came in around $0.44.
So good momentum on the core earnings metrics. How they manage that?
Well, a key driver was the net interest spread. It expanded quite a bit.
Okay.
Got up to around 150 basis points. Remember, it was 132 basis points back in Q1.
Right. And what drove that expansion?
Primarily lower financing costs. Their average cost dropped by about 17 basis points. That makes a big difference.
Sure does. And the portfolio itself?
Also growing. The investment portfolio expanded 4% over the quarter. It's sitting at roughly $8.6 billion now.
Okay, so good EAD, good spread expansion, growing portfolio. Sounds pretty positive. But there's usually another side of the coin, isn't there?
Yeah, usually. Yeah.
They kept the dividend steady at $0.20, right?
Cool.
Seventh quarter in a row.
That's right. Covered by the EAD. But the adjusted book value per share, it actually dipped slightly, down 1.6% from Q1, ended the quarter at $10.26.
Okay. So EAD strength, but a bit of pressure on book value. What about leverage?
Leverage ticked up. Recourse leverage went from 3.4 times in Q1 to about 3.8 times.
And just quickly, recourse leverage means?
It means the lender can potentially claim more than just the specific collateral if something goes wrong. It's, a measure of risk exposure.
Got it. And liquidity heading into Q3.
They had about $460 million ready to deploy, so firepower available. But worth noting, the GAAP EPS was actually negative, -$0.04.
Right. So, and that highlights that tension, doesn't it? Strong operating earnings, the EAD, versus maybe how the market's valuing the underlying assets showing up in book value and GAAP.
Exactly. A nuanced picture.
Okay, let's unpack this because the biggest strategic news, the real headline grabber, was the Constructive Loans deal, wasn't it?
Absolutely. A game changer, potentially.
Tell us about that. They bought the whole thing.
Yep. Acquired the remaining 50% they didn't already own. Happened just after the quarter closed, July 15th. Paid about $38.4 million in cash.
And the rationale. What's the big idea here?
Management's framing it as immediately accretive to EAD. They're talking about an annual equity return around 15%, maybe higher over time.
50%, okay.
But the real story here, I think, is the vertical integration. They're not just buying loans anymore. They're bringing the origination engine in-house.
For business purpose loans, BPLs.
Exactly. Gives them direct control over that pipeline, a path to, more scalable recurring earnings. It's a fundamental shift.
So this Constructive Loans model, what does it actually do? How does it work?
It's an originate to distribute model. So they create the loans, but then they sell a good chunk of them off to other investors.
Okay. So it's not all going onto Adamas's balance sheet.
Not necessarily. It lets them earn fee income and really scale up the origination volume without needing massive amounts of Adamas capital tied up in every single loan. Adamas will still buy some selectively for their own portfolio.
Makes sense. And the type of loans Constructive focuses on?
Heavily weighted towards BPL rental loans. That's like 93% of their mix. Only about 7% is in bridge loans.
Interesting distinction. Rental focus. Now, this all sounds good strategically, right?
Okay.
Capital light, fee income, vertical integration. But these big moves always have costs, don't they?
They do. You're right to ask.
What about the financials? G&A, leverage.
Yeah, that's the trade-off, or at least the investment cost. G&A expense ratio. Expected to nearly double, going from around 3.4% up to somewhere between 6.2% and 6.4%.
Wow. Okay. That's significant.
It reflects the cost of building and running that origination platform internally. And as we mentioned, recourse leverage is expected to tick up slightly too by about another 0.2 times just from this deal.
So the promise is their EAD accretion, strategic control, but you've got to watch those costs and the leverage closely as they integrate it.
Execution risk, right?
Always. Integration is key, making sure those projected returns actually show up.
And this constructive deal, it wasn't happening in isolation, was it? It sounds like part of a much bigger portfolio shuffle.
Oh, absolutely. This fits into a broader, pretty aggressive portfolio rotation they've been executing.
What else have they been doing?
Well, they completely got out of their remaining multifamily joint venture equity positions, sold the last 4 in July. That whole exit process actually started way back in 2022. So, shedding the multifamily equity. Where's that capital going?
It's being rotated, along with proceeds from future multifamily mezzanine loan payoffs, into what they see as their core single-family strategies.
Which are?
Agency RMBS, residential mortgage-backed securities, and more of those BPLs we were just talking about. Management clearly believes those offer better EAD accretion.
So basically trading maybe lower yielding older assets for things they think have more juice. Higher growth potential.
That's exactly the narrative. It's a clear bet on where they see future returns.
How does that change the portfolio mix now?
Significantly. Agency RMBS is now 57% of their assets, 38% of capital. And they said the long-term target for agencies is maybe closer to 50% of total equity.
And the return profile driving this, you mentioned agencies were better.
Yeah, the comparison is pretty stark. Agencies on a fully hedged basis, they see mid-teens returns potentially flexing into the high teens.
Okay.
BPL rental loans, also mid to high teens potential. Compare that to the multifamily mezz they're exiting that was more low double digits, maybe low teens at best.
Right, so the math seems clear from their perspective.
Yeah.
Where did the money go in Q2 specifically?
Big deployment. $504 million into Agency RMBS. Another $294 million into residential credit.
And within that residential credit?
Mostly BPLs.
Yeah.
$217 million went into BPL bridge loans and $61 million into the BPL rental loans. So very deliberate moves.
Okay, we've got the internal strategy map pretty clear now, the constructive acquisition, the rotation into agencies and BPLs. But how is all this playing out against, the real world, the economy, the markets? Here's where it gets really interesting, I think.
Yeah, this is crucial context. Management is definitely positioning the company based on their read of the macro environment.
And what's that read?
Well, Q2 2025 saw some softening economic indicators. Some economists started trimming GDP forecasts for this year and next.
Okay.
Against that, Adamas management actually anticipates a steepening yield curve in the coming months.
Meaning long-term rates rise faster than short-term rates.
Exactly. And they believe their portfolio, particularly with that heavy agency RMBS allocation, is well set to benefit if short-term rates come down.
How so? Explain that link.
Simple version. If short-term borrowing costs fall and the yield on their longer-term assets like RMBS holds up or rises, that net interest spread the gap between what they earn and what they pay widens. That boosts profitability.
Gotcha. So it's a strategic bet on interest rate movements, essentially.
A calculated one, yeah, tied to that portfolio shift.
What about the housing market itself? That must be critical for a mortgage REIT.
Absolutely. And it's a mixed picture, which actually plays into their strategy.
How so?
Home prices are still high overall, right? But some of those really hot markets are starting to cool off a bit.
Okay.
But crucially, rental demand keeps climbing, and the homeownership rate has actually dipped back to 65%. That's like levels from the 1980s.
Wow. So fewer owners, more renters.
Which means strong demand for rental housing and also a continued need for non-agency credit products, like the BPLs Adamas is focusing on, particularly those rental loans. It supports their strategic direction.
Makes sense. It seems like BPLs are a real focus area, maybe even a sweet spot for them now with Constructive. But are they the only ones seeing this? What's the competition like?
That's a really important point for the outlook. Competition is heating up, particularly in the BPL bridge loans segment.
Why bridge specifically?
It seems to be driven by the increasing use of rated securitizations for those types of loans. It's basically opening up competitive financing to more players.
And the impact?
It's pushing down the yields you can get on those bridge loans. Spreads are tightening. Management even hinted they might need to be more selective buying bridge loans going forward because of this.
Which kind of reinforces the value of the Constructive acquisition, focusing so heavily on the rental BPL side, right? Less competition there, maybe.
Potentially, yeah. It highlights why that 93% rental loan focus within Constructive might be quite strategic.
So, while they're reshaping the portfolio and strategy, they also changed their name. Adamas Trust. Why the rebrand? Just cosmetics?
I think it's more than just cosmetics. The change to Adamas Trust, new ticker ADAM, effective September 2nd, management explicitly said They hope it helps reset the equity story.
Reset the story. How?
By aligning the company's public identity with this new strategic direction, moving away from maybe the older New York Mortgage Trust perception towards this focus on scaled recurring earnings driven by things like the Constructive deal, it's a signal to the market.
A signal of transformation, basically.
Exactly. This is who we are now. This is where we're going.
Okay, so pulling this all together, what does it mean for you, the listener, trying to figure out Adamas Trust? We have this clear strategic pivot, strong EAD, dividend coverage, but also that book value dip, the leverage increase, the macro questions. It's not simple, is it?
Not at all. It's definitely nuanced. Management themselves describe their outlook as cautiously bullish. They see the opportunities, but they're aware of the complexities.
So what are the key things investors should be watching? What are the catalysts or risks?
Okay, key things to watch. First, the constructive integration. How quickly can they ramp up BPL originations and securitizations? Does it deliver that promised EAD boost?
Right, execution.
Second, funding costs. If short-term rates do ease like they anticipate, will that provide the spread tailwind they're hoping for?
Makes sense.
Third, the dividend. EAD is covering it now, but how does that policy evolve relative to EAD and book value trends?
Always a key question for REIT investors, and specifically for Q3.
Monitor that EAD and book value per share cadence. Keep an eye on leverage levels, and listen very closely to what management says about competition in the BPL market, especially bridge versus rental.
Because the market's immediate reaction, even with the EAD beat, seems pretty focused on that book value drift and maybe broader macro fears, right?
Precisely. So it's this balance, solid operational results versus wider market sentiment and those specific financial metrics.
Okay, so we've dissected the strategy, the numbers, the market context. Now for the part of the show where we stretch our thinking a bit.
The outrageous but plausible zone.
Exactly. And let me just say very clearly, this is absolutely not financial advice, purely educational, thought-provoking ideas based on the call.
Couldn't stress that enough. Just exploring possibilities.
So given everything we've discussed about Adamas Trust, what kind of unconventional trade ideas might someone ponder?
Okay, here are a couple to chew on. Again, purely hypothetical.
Got it.
Idea one, long Adam, but with a protective collar.
Okay, break that down. Long Adam because?
Because of the strong EAD, the dividend coverage, that clear strategic pivot, the potential story reset with the rebrand, there's a positive case to be made.
But the collar, why protect?
Because of those concerns, the market flagged the book value pressure, the leverage, the general uncertainty around rates, and the macro picture. A collar helps manage that downside.
How does it work again? Simply.
You buy the stock. Then you buy an out-of-the-money put option that sets a floor price, your insurance policy. To help pay for that put, you sell an out-of-the-money call option, which caps your maximum upside somewhat.
So you participate in potential gains from the strategy working out, but you limit your losses if things go sideways.
Exactly. Capturing upside while hedging the downside risk in a volatile environment.
Okay, interesting. What's idea number two?
Idea two is a targeted BPL sector pair trade.
A pair trade. So long one thing, short another.
Precisely. Based on those dynamics we discussed within the BPL market itself.
Right, the bridge versus rental loan competition.
Yes. Remember how BPL bridge loans are facing more competition and tightening yields because of those securitizations?
Yeah.
So the idea would be to potentially short a company, another REIT or financial institution that you identify as having a really heavy, maybe undiversified exposure specifically to those BPL bridge loans.
Okay, betting against that tightening segment and the long side.
Go long, Adamas Trust. Why? Because their big strategic bet via Constructive is overwhelmingly focused on BPL rental loans, that 93% mix. And they have that originate to distribute model aiming for capital light fee income in that potentially less competitive, better growth segment.
So you're playing this specific difference in outlook between BPL bridge and BPL rental, using Adamas as the long vehicle for the rental side.
Exactly. It's a way to capitalize specifically on the sector nuances that came out in the earnings call commentary.
Very specific. Definitely fits the outrageous but plausible category. Again, not advice, just ideas to mull over.
Just food for thought.
So let's wrap this up. Adamas Trust, clearly in the middle of a major strategic shift, doubling down on BPLs, particularly rentals via Constructive, and Agency RMBS.
Yep. Shedding the legacy multifamily, aiming for more scalable, recurring EAD to support that dividend, all while navigating book value adjustments and a shifting market.
Management is painting a clear picture of where they want to go.
They are. The focus now is on execution, integrating Constructive effectively, and managing those leverage and cost metrics while navigating whatever the market throws at them next.
And it leaves you wondering, right? As the housing market continues to evolve, maybe unevenly, what does this specialization in BPLs mean long term? Does it become a huge advantage, or does it create new risks down the road?
That's the billion-dollar question, isn't it? Something for investors to keep tracking very closely.
Absolutely. And as always, do your own homework, dig deeper than just our conversation today. Thorough research is key.
Couldn't agree more. Thanks for tuning in for this deep dive on Adamas Trust.
Yeah, thanks for joining us. We'll catch you on the next one.